This was basically waiting, difference between waiting for candles to close versus before candles close. This is very important. I think in the live stream sometimes, we take trades before the candles close and we anticipate candles to continue moving. And for some people, this may be risky, and that's right. Like when you're entering a position before candles close, it's a very risky business, so you have to wait for candles to close. Like it takes a lot of experience. So let's see this. So entries before candles close, it's risky. There's a low probability, but before we talk about that, you have to understand that, okay, is the candle breaking a high or is the candle breaking a low? You really have to understand this. So for example, let's say, so we're going to do simulation after this and we'll see if you have any examples there as well or not. So like, let's say you have a support right here, or actually, let's say you have a resistance up over here, and you have a candle that's closing like this, and you know that, okay, this is a time of volume and there's going to be volume here. Oh, by the way, I had this one question I noticed. Okay, fake out question. Yeah, problem. So let's say you have a candle opening like this, and now what someone can say, okay, well, as the next candle starts breaking the high of the previous candle, someone's going to say, okay, I'm going to enter right over here. Someone's going to take an entry right over here. They'll say, okay, it's breaking the high of the previous candle. So once it's breaking the high of the previous candle, this is where some really risky trader is taking an entry, anticipating price to continue moving bullish, because now if we look at the trends, candle trends, if price is moving up, it's going to make higher highs and higher lows, higher highs, higher lows. So once it's breaking the high over here, then that means it's made a low right over here. So now you're saying is that, okay, if I'm going to take an entry over here, I'm keeping my stop loss below the candle low and I'm expecting price to continue moving bullish. The reason why it's risky is because maybe the candle is making a high and once it breaks the high, maybe then it's going to come down and create a low and maybe continue moving down. That's why it's risky when you're not waiting for candles to close. Maybe I think probability of success in this scenario, I think it's going to be 60%. There's still a probability of success, but it's not too high. It's low because it's risky. You're basically anticipating that once the candle breaks the high, you're anticipating the next candle to continue moving bullish. So that's why it becomes risky. In the same essence, if you have candles moving bearish and you have a candle breaking the low, let's say, of the previous candle, so you're taking the entry as it's breaking the low, keeping the stop above this candle, the current candle, anticipating price to continue moving bearish without coming up to breaking its own high. So you'll have to watch it again to really understand this. So again, once the candle breaks the low of the previous candle, what a risky trader is doing, they're taking an entry here, anticipating that, okay, well, this candle has probably made a lower high over here, and now it's going to continue on to make a lower low. This is mostly done when you have pairs that have a lot of volume. So you have TJ, you have GPCAD, gold, like these very high volume pairs, they will mostly they will do this. Once they break the low and they're not closed, someone's going to take an entry and then they will continue moving down. Something like this happened in the Asian session on Thursday. After the big move up, it took a sell once it broke the low of the previous 30-minute candle, anticipating that it will continue moving down without breaking the previous high. So it's very risky. I don't expect people to do this from the get-go. It definitely requires experience. Some people I have in the group, they do this very, very successfully. And that's mostly the only thing they do right now because, they've really looked at it. They've really seen it happen over and over again. And they've come up with their own conclusions based on this. So this requires a lot of practice. Similar to stop orders. Yes, exactly. This is similar to stop orders. Like let's say if you have a sell stop down here, if it gets activated, then you're not expecting price to come back up over here. So again, this is risky, right? This is very risky. So you need to see this happen a couple of times before executing this. Like it took me personally, it took me almost 8 months to get comfortable with this, so it will take you time. Let's go to the next point here because we had a lot of points over here. Oh, what time frame are you looking at? 30 minutes and above are the best. Yeah. So the best time frames when it could happen is going to be on your 30-minute and the 1 hour time frame. If someone says, oh, like I'm going to look at a 15-minute time frame, don't even bother. It's a weak confirmation time frame. The risk gets up. Like as you go down the time frames, the risk of you getting stopped out, it becomes higher. On the 1 minute gets higher, 5 minute, it gets a little less, 15 minutes, the risk is still there. 30 minute is pretty good. 1 hour is really, really, really good. 1 hour and 30-minute time frames, man, they are the best time frames to look for confirmations within a session. 4 hour is also really good if you're trying to trade off the daily. Daily is also really good if you're trying to trade off the weekly, but if you're trading inter-sessions, 1 hour and the 30-minute candles, they are the best. The 15-minute can also work, but it takes a lot of practice too, because there's smaller time frames. There's a higher chance of price to do odd things here and there. So it takes a lot of getting used to. Next, we have entries after candles close. This is extremely safe, and this has a very high probability of things to work out, so let's take a look here. Has the candle broken the high or a low? This is really important. Has the candle really broken the high or really broken the low? This goes to a fact again. Now we're going to go back to our example here. Now see, trading is really simple. It's not hard, because what you're going to see is I'm using the same examples to explain different concepts, because you're just reading candles. If you have a candle closing bearish at resistance, it's closed, and now you can say that, okay, well, now this candle has closed, so I might want to take a trade here, or let's say that, okay, let me just do a better example. Let's say that you had a support over here and we had candles coming down, we had candles coming down over here, candles came down, and now you had another candle that came down over here and closed kind of like this, with no wick at the bottom. And then you have the next candle that starts forming and it starts breaking the high of the previous candle, right? Now, once this candle starts breaking the high of the previous candle, someone can say, oh, well, look at this. Before the trend was bearish, making lower highs and lower lows, right? Lower highs and lower lows. And now this candle is starting to break the high of the previous candle. A more aggressive trader will say that, okay, perfect. Since it's breaking the high of the previous candle, I'm going to take a buy over here and I'm going to put my stop below this current candle, expecting now, since it's breaking the high, it's more likely to create a support, and then once I'm in this trade, then I'm expecting the next candle to make a low and then continue moving up. That's what a risky trader is going to do. A more aggressive trader. A more conservative new trader is going to say, whoa, Mr. Risky Trader, that does not make sense. So what you should do is you should basically wait for this candle to close. Let's say the candle closes like this. And you're going to say, okay, well, perfect. Now the candle has closed bullish. This means a support has been formed. So now I can expect the next candle to respect the low of the previous one and continue moving bullish. That's where you're waiting for candles to close. Because now you waited for candle to close, it closed at a support, and now you can say, okay, perfect, I'm going to take a buy and we're going to have a nice day. So this is a 30-minute time frame. Now, for example, let's say that the 30-minute candle closes bearish like this, right? It closes bearish, but it closes above support. What are you doing at this point? And your stop loss is down over here. What are you doing at this point? What are you doing with your risk management? You're taking some percentage half. Like it's not a set rule to take off 50% or 25 or 75. Like you can really adjust that, but for me personally, I'm taking some percentage off because if I see a 30-minute candle, which is a higher confirmation candle closing bearish above support when I'm in a buy, man, I'm taking some risk off, because that could mean that maybe the next candle can break support, and we've seen this happen. We've seen this happen a lot of times, it just breaks support. And you're like, oh, well, I don't know it's going to break support. It hit my stop loss. So that's why you have to take percentage off. Because if you've taken some percentage off right over, what the hell is this? Okay. So if you've taken some percentage off over here, right? Now you've closed, let's say I close 50%, and if price hits my stop loss, now I don't feel bad, because I lost 50% of what I intended to lose. Maybe I lost, let's say, 70% of what I intended to lose, because maybe I closed half over here in a drawdown. Obviously, like you go in a drawdown and you closed half, and then price hit your stop loss. So essentially, you still lost less than what you intended to lose. This is very important. Losing less than what you intended to lose. We talked about time frames here, what time frame are being used for confirmation. Again, the 30-minute time frame is really, really important. We talked about stop loss, where you place a stop loss. Traditionally, I put stop losses above and below the 30-minute or the 1-hour candles. 30-minute or the 1-hour candles. That's where I put my stops. It's very, very essential here. We've also talked a lot about how to give trades a second chance. It's discussed in a webinar called that's the name, right? How to give trades a second chance. If some people don't have access to the database, I will post the link to that webinar in the Slack, so you can have a look at that. Let's see what we have next over here. I've noticed I do really good webinars when I'm fasting. I wonder what Rakesh thinks about this. Like whatever. Okay, let's go to the next one here. Breakouts versus fakeouts. So now, breakouts versus fake. Now, this one question we had, and this question was that how do you, that when a breakout is going to happen, but how do you know if fake out is going to happen? The thing is, we don't know when a fake out is going to happen. We just don't know. A fake out is there to fake you out. It's like when you play football, and someone dodges you. It's like, oh, how can I anticipate that dodge? Someone will say, well, you can't, because the dodge is supposed to dodge you. So a breakout, best way to find this is to wait for candles to break and close above the candles to the left. That's a really, really good breakout. But because sometimes what happens is that you're going to have a resistance here, and you're going to have candles, closing like this, and then you have candles go down, you have candles go back up, you have candles close like this, and then sometimes you're going to have a candle that wicks up, but it closes down over here. This is not a breakout. I've seen people take trades over here. They'll say, oh, the candle wicked up and closed back below. This is not a fucking breakout, man. The candle closed below support. This is what really grinds my gears, because you have to look at the closes. Candle closed below support. It wicked above support. It tried to go above support, but it closed below support. You need a candle to break and close above support. Once you have a candle breaking and closing above support, this is called a breakout candle. And you're placing stops below the breakout candle, and now you're anticipating the next candle to continue moving bullish. And this is why buy stops are more risky. Perfect, Ben. Ben said buy stops are more risky here, and this was my next point. This is why buy stops are risky. Because you could have a buy stop up over here. This can wick up and activate that buy stop and then close down over here. Take this past week and the week before, this happened to a lot of people, where they had buy stops and sell stops, and they got activated, and then candles came back in a drawdown. So this is something very important. So always wait for candles to break and close above support, because once you have a candle breaking and closing above support, man, this is your breakout candle. Now you can anticipate the next candle to continue moving bullish without breaking the low of the previous candle, because you're expecting price to continue moving up. Typically on the 30-minute and the 1 hour are the best confirmations, and these are the very high probabilities. Understand that for inter-session trades, 1 hour and the 30-minute are really high probability setup. So you're always looking for them. So fake outs, you can't anticipate fake outs. We had a question about fake outs that, oh, well, like sometimes, price breaks up and then the next candle, it just starts coming down and then starts to go the opposite way. This happens, like these things happen. When these things happen and you have a stop loss here, down over here, you have a stop loss. Now, this is the point where you have to close 50% positions or 25 or 75. I mean, don't take this as like written in stone. You have to close 50. That's my rule. I use that rule. So you have to decide, okay, how much you're going to close. Like if you see sometimes what happens is that like, if a candle, let's say it breaks out and you have the next candle starts coming down over here, starts coming to your stop loss, but it closes like this. At this point, you're still thinking, man, we had a candle closing up over here. There's still a chance that the next candle can go up. Like, should I close? Should I leave it open? What should I do? So at this point, when you're doubting yourself and you still think price is going to go in your way, just close 50%. It's much easier, because you're taking risk off. So fake outs, you can't anticipate fake outs. They just happen. The only thing you can control is risk. Let's move on to the next slide here and let's see what we have coming. Okay, what's this? Missed a move. How to make sure you catch it later. This was a question we got too. This was a question on, let's say you miss a move. How do you look back and say that, okay, how could I have caught this move? This was a very important question. And the thing is, you have to, before you ask this question, you have to ask yourself 5 questions. The one question is that, did it happen during my trading time? Like when, let's say you wake up at, like most times, I wake up at New York Open and like, and then Monty comes on the stream and I see the chart and like a chart has moved a lot and Monty says, oh yeah, we had this big move. So I'm like, okay, well, how could I have caught this move? The number one thing I'm going to look at is, okay, did this move happen in my session? Does this even make sense for me to look at this and say, okay, how could I have caught this move? If that move happened in, let's say, the pre-London, which is at 2 a.m. at my time, it makes no sense, because I'm like, well, I'm sleeping at this time anyway, so it makes no sense for me to look at it. Next thing is, was I anticipating this? A great example is the very bullish move that happened on Thursday on GJ when GJ crossed above 133, 300 and went to essentially 134, 800, 135. So that was something a lot of people were anticipating. A lot of people said, okay, man, like we were anticipating this move to happen, but we missed this move. Sometimes, there will be no explanation how to catch this move. Like price just moves, there was just one giant candle that moved. I had a buy stop, it got activated and luckily it moved. Some people like, they also had buy stops and some just sat and watched. Sometimes there will be no way to catch this. Second is going to be, was there a way you could have caught this move? There's always a way. Sometimes there is not a way, but most times there's a way. It's by looking at the small time frames. What did the lower time frame indicate? This takes some experience. I'll say this takes some experience. Let's say if you're looking at the 15-minute or 5-minute, you're going down to small time frames to really study. Like, okay, what could I have seen in the smaller time frames to maybe anticipate it happen? Because these moves will happen all the time. If they will happen all the time, not as often as you want them to happen, but they will still happen, and now after like, 3 years of me looking at GJ on a regular basis every morning from 6 to 9, I have came to a conclusion that GPJPY, most of the time, it will not do a retest and it will continue moving on. And still I miss moves, and I still look back and look at the lower time frames and I see, okay, were the lower time frames creating lower highs and lower lows, or the lower time frames creating wicks? If let's say the 30-minute candle, let's say that there was a move that happened like this, there's a move that happened like this and you had the next candle that moved like this and then you had the, next candle that moved like this. So when you have something like this happening, let's say on the 1 hour time frame, Then you can go down to the 15-minute time frame. On the 15-minute time frame, you might see that, okay, candles went up, and then they formed some sort of a resistance, and then they start to go down. They reached some sort of a support, which was right over here, and then they start to break further down. Now, this is the 15-minute time frame, which is a lot riskier, but you're looking at it to see that, okay, how could I have caught this move? This is where you really start developing as a trader. You know, when you start to look for little things, which most people don't look at, you know, and then you start to make notes, and then you bring this information into the next day, you know, because always, whenever you're missing moves, look at the chart and see that, okay, how could I have caught this move? Right? Look at the lower time frames, you know, so because this scenario happens a lot of times, you know, and the only way to break this down is by looking at the smaller time frames. I know this goes against the rule of saying, yeah, don't look at the small time frames, you know, but if you're really trying to push the boundaries of being an experienced trader, you're looking at the smaller time frames to just get like ideas. You know, I know some people here, they do push the limits onto the small time frames, you know, just to get that little bit of an edge. It's just to get like those little ideas that, okay, maybe this could have been the way I could have caught this move. Right? So again, this requires a lot of experience in watching these moves happen over and over again. Once you see repetitive things happen, you get more confident in execution. You know, like it all, trading is all about watching it happen over and over again. Man, trust me, like if you're not over trading, I can guarantee you this, if you are not over trading and if you are not over risking, trading will become way easier. And if you're closing 50% in a loss, let's say a price goes against you, you're taking off 50%, trading will get even more easier and it will get really, really enjoyable because you're not blowing accounts. You're not getting anxiety because you're over trading. You're not getting anxiety because your stocks are getting hit at 100%. You know, like it's just going to be very, very amazing. So that's, for me, what really changed trading was securing my loss early. You know, that's something that really changed everything. Securing my loss early and really focusing on one or two trades and really cutting down my chart time, man. Like a lot of people, they have the habit of looking at the chart for 5-6 hours. Like, why? What are you trying to get out of the charts? Like charts are not going to show money which you can grab from it. You have to have a time, like 3 hours. I think 3 hours is more than enough in a day. 3 hours is way more than enough. You know, I see some people trying to take trades like after London close, after like, you know, New York close in the afternoon. It makes no sense. You know, you have to cut down your trading hours. Seriously. Just cut them down because no one likes to work. You know, trading for me is like working and I don't want to work more than 3-4 hours. You know, I want to be able to tell somebody that, hey, you know what? I worked for 4 hours or 3 hours and that's all what I did today. You know, that's what trading. We all come to trading to have independence of time. And if we don't have independence of time when it comes to trading or looking at the charts, man, things are not going to work out at all because then you're going to be prone to take more trades. You're going to look at the charts when you're not supposed to look at the charts, especially when you look at the London session. But now when you're looking at the New York afternoon session, there will be a wild difference in the way, you know, things move in two sessions. So we're going to cut the presentation here. I hope this was informational. So now we're going to use some of the things we talked about here in a form of a simulation, right? So we're going to go to a simulation here. Just give me a moment. And I hope in the simulation we can get some more things talked out. So let me see how I can stop this. Maybe like this.